On the EURUSDT 15-minute chart, our analysis was designed to establish a precise, structured, and disciplined understanding of price action through a comprehensive study of candlestick behavior, market structure, momentum dynamics, and key technical zones. The foundation of our approach began with a detailed examination of how each candlestick forms within a 15-minute interval. Every candle represents the battle between buyers and sellers during that specific time window, and the open, high, low, and close prices collectively reveal the strength, hesitation, or dominance of one side over the other. By analyzing the relationship between these four components, we gain insight into short-term sentiment and potential continuation or reversal behavior. A strong bullish candlestick, characterized by a large body and a close near its high, often reflects aggressive buying pressure and confidence in upward continuation. On the other hand, a strong bearish candle closing near its low indicates decisive selling activity and the possibility of further downside movement. However, beyond the body size alone, we also paid close attention to wick formation. Long upper wicks frequently signal price rejection at higher levels, suggesting that sellers are defending resistance zones. Similarly, long lower wicks often indicate buying absorption at support levels, where demand overcomes selling pressure. The proportion between body and wick size helps assess volatility, exhaustion, and potential shifts in short-term momentum. Moving beyond individual candlesticks, we analyzed how candles interact collectively to form patterns and structural clues. Consecutive bullish closes forming higher highs and higher lows reinforce trend continuation and demonstrate sustained buyer control. In contrast, slowing momentum can be identified when candle bodies shrink, wicks become more prominent, or when price begins forming lower highs within an uptrend. Reversal formations such as engulfing patterns, rejection candles, and structural breaks were evaluated carefully, but always within broader context. We emphasized that no candlestick pattern should be interpreted in isolation. Instead, it must align with overall market structure and key levels to carry higher probability. Market structure analysis formed the core of our methodology. By mapping swing highs and swing lows, we identified whether the market was in a bullish, bearish, or neutral phase. A sequence of higher highs and higher lows confirmed bullish structure, guiding us to look for buying opportunities during pullbacks toward support zones. Conversely, lower highs and lower lows confirmed bearish structure, encouraging a selling bias during retracements into resistance areas. Structural shifts, such as a break of a previous higher low in an uptrend, signaled potential trend transition and required reassessment of bias. Recognizing these transitions early allows traders to adjust positioning and avoid trading against emerging momentum. Support and resistance levels were identified using historical reaction points, consolidation ranges, liquidity zones, and psychological price areas. These levels represent zones where institutional participation and significant order flow may have occurred previously. When price revisits such areas, we observe the reaction carefully. A strong rejection from resistance accompanied by bearish confirmation strengthens the case for downside continuation. Alternatively, a decisive breakout above resistance with strong candle closes and follow-through suggests sustained bullish expansion. Importantly, we avoided reacting to false breakouts by waiting for confirmation through candle structure and momentum continuation. Consolidation phases were also studied in depth. During ranging conditions, price fluctuates between defined support and resistance boundaries, reflecting equilibrium between buyers and sellers. Volatility often contracts during these phases, increasing the likelihood of false signals. We stress the importance of patience during consolidation, waiting for a clean structural breakout supported by momentum before considering trade execution. Understanding the transition from consolidation to expansion is critical on the 15-minute time frame, as intraday volatility can increase rapidly once equilibrium is broken. Momentum assessment was incorporated through the observation of impulse moves and corrective waves. Strong impulse candles with minimal retracement indicate directional strength, while choppy overlapping candles suggest uncertainty. By comparing the strength of impulsive moves versus corrective pullbacks, we assessed whether the dominant trend remained intact or was weakening. This relative strength comparison adds depth to structural analysis and improves timing precision. Risk management remained central to the entire framework. Every potential setup required defined stop-loss placement based on logical structural invalidation points rather than arbitrary distances. In bullish setups, stops were placed below recent structural lows or support zones. In bearish setups, above recent swing highs or resistance. Profit targets were determined using previous structure levels, measured move projections, or risk-to-reward ratios that justified exposure. Maintaining disciplined risk parameters ensures long-term sustainability regardless of short-term outcome variability. Psychological discipline was equally emphasized. Emotional trading, impulsive entries, and overreaction to minor price fluctuations often lead to inconsistency. By following a structured analytical framework grounded in observable price behavior, traders can reduce emotional interference and improve decision-making clarity. Consistency arises not from predicting the market perfectly, but from executing a repeatable process with controlled risk. In conclusion, our comprehensive EURUSDT 15-minute chart analysis integrates candlestick interpretation, structural mapping, support and resistance evaluation, consolidation recognition, momentum comparison, and disciplined risk management into a cohesive trading methodology. This structured approach enhances objectivity, strengthens market awareness, and supports rational execution, while a large bearish body closing near its low reflects sustained selling pressure and potential downside continuation. The size of the body compared to the wicks provides additional insight into momentum and volatility. Long upper wicks typically suggest rejection from higher price levels, often near resistance, signaling that sellers stepped in to push prices back down. Conversely, long lower wicks can indicate rejection from support zones, where buyers absorb selling pressure and drive the price upward. Beyond individual candlesticks, we carefully analyzed how candles interact with one another to form patterns and reveal shifts in momentum. Consecutive bullish candles with higher closes may confirm trend strength, while smaller-bodied candles following a strong impulse move can suggest slowing momentum or the beginning of consolidation. Engulfing patterns, inside candles and breakout candles were also evaluated to determine potential continuation or reversal scenarios. However, we emphasized that no single candle should be interpreted in isolation. Instead, each candle must be understood within the broader context of market structure and prevailing trend direction. Market structure played a critical role in our analysis. By identifying sequences of higher highs and higher lows, we confirmed bullish conditions and looked for buying opportunities near support or during pullbacks. Similarly, lower highs and lower lows indicated bearish structure, guiding us to focus on selling opportunities near resistance or after corrective retracements. We also studied transitional phases where structure shifts occur, such as when a lower high forms after a strong uptrend, potentially signaling the early stages of a trend reversal. Recognizing these structural changes helps traders adapt their bias according to evolving market conditions. Support and resistance levels were marked based on previous reaction points, where price demonstrated strong rejection or consolidation. These levels act as psychological zones where market participants historically showed significant interest. When price approaches support in an uptrend, we observe whether buyers defend the level with strong bullish candles or whether a decisive breakdown occurs. Likewise, when price tests resistance, We assess whether bearish rejection appears or if a breakout is supported by strong momentum and volume. Breakouts were not taken at face value. Instead, we looked for confirmation through solid candle closes beyond key levels and follow-through price action. We also evaluated consolidation phases, where price moves within a defined range, forming a balance between buyers and sellers. During such periods, volatility typically decreases and false breakouts become more common. Understanding consolidation helps prevent premature entries and prepares traders for potential expansion moves once the range is decisively broken. Patience and confirmation were consistently emphasized throughout the analysis to avoid emotional or impulsive decisions. Risk management was integrated into every aspect of the chart reading process. Proper stop-loss placement below structural support in bullish setups or above resistance in bearish setups was discussed as essential for capital protection. Profit targets were aligned with logical structural levels, ensuring that reward potential justified the risk taken. By combining disciplined chart analysis with structured risk control, traders can improve consistency and reduce unnecessary exposure. Overall, this comprehensive approach to analyzing the EUR/USDT 15-minute chart promotes clarity, objectivity, and disciplined execution. Rather than relying on speculation or emotional reactions, traders can interpret price behavior through measurable factors such as candlestick strength, structural progression, momentum shifts, and key technical levels. Continuous practice of this structured method enhances market awareness, strengthens analytical skills, and supports long-term development in trading performance.